Welcome to the Meet the CEO show on Core Finance. My name is Simon French and I'm the Chief Economist of Stockbrokers Panmure Gordon. I'm also joined by David Buick, Panmure's legendary city commentator. It is our pleasure to welcome to the show George Maxwell, CEO of Eland Oil Gas. Eland is an independent oil and gas company focused on production, development and exploration in West Africa, particularly the highly prolific Niger Delta region. Eland is listed on the London AIM market with the ticker ELA.L. George, can I extend a huge welcome to you from us both?
George has been CEO of Eland for 3 years, having served on the board since September 2009. George has over 20 years oil industry experience in both the producing and service manufacturing arena. He's held previous high-profile roles with ADVFN and ABB Oil and Gas, and has worked across the world during his very distinguished career. Eland is currently valued at 120 million, with shares up 35% since the start of 2017. Since it floated in August 2012, Eland has exhibited more resilience than the benchmark UK-listed oil and gas sector, and has outperformed that index by 33%. George, can you give viewers a brief rundown on Eland, its assets, and why Nigeria?
Well, we formed Eland back in 2010. A partner and myself were ex-ADEX employees. So we both worked and lived in Nigeria through 2004 towards 2010 when ADEX was sold to Sinopec for a considerable sum, one of the most successful divestitures in Nigerian history. We looked at the opportunity, having lived and worked there. We saw great potential. We saw that we'd had some success with ADEX, and we looked to reinvest both our intellectual and financial capital back into the country. Nigeria is one of the few places that has a very stable fiscal environment. Unlike places like the UK or the US, you don't see windfall profit tax coming through from Nigeria when there are high oil prices. Equally, there are some investment incentives given at low oil prices, and Eland actually enjoys one of those investments right now through its joint venture company Elcrest with the tax-free status from Pioneer Tax. Mm-hmm. The other main reason is obviously it's one of the most prolific oil and gas regions in the world. The largest producer in Africa. It is quite an open market. So there's very few places where you can buy assets of such size and such quality with low geological risk, but still have an environment where the monetization of the crude, which is really why we're all here, how do you monetize the product, yeah, and the repatriation of those funds back to London or back to investors is always possible. So despite some of the half-truths and misnomers around Nigeria, it's actually quite a stable place to do business when you look at the fiscal and business environment.
And one of the challenges you've had since flotation in 2012 has been a tough sector, the oil and gas sector, and yet you've managed to weather it better than most. You mentioned Pioneer Tax, you mentioned a series of ways which Eland has managed to buck the market to some extent. What other things have you done to insulate from the vagaries of the global spot price?
Well, there's a couple of things there. One, you have to have a good asset. So at the end of the day, for an oil and gas company, all the value is under the ground. Mm-hmm. So having that being a given, the complexities around Nigeria in order to monetize that position, all the complexities are actually above the ground. The geological risk is very low. Mm-hmm. So we've used both our experience in country. We have had the key issue here is we don't control the commodity price. We're in a rather unique scenario in the oil and gas business where you sell your product at whatever the market decides the product is going to be worth. So the real area for us is to look for positions where we can have effective cost control, where we can look at the lowest cost of operation, where we have a strong and efficient fiscal environment. And at the end of the day, for Eland, we're looking at, we're investing into the country. So you need to have a strong and an understanding investor base that looks at the opportunities that we present, which is, there is all kinds of aspects of oil and gas from wildcat exploration through to producing assets. We chose to look at near-term production assets, and because of the relatively low cost that we entered in, we've got ourselves in a position where at the time of high oil prices, when big, large, deep water projects worth billions of dollars were being funded, we came in with a rather modest and we find very attractive asset that can survive the vagaries of the ups and downs in the oil market.
And you spoke about a patient shareholder register, and one of the challenges you've had to deal with is the export route through the pipeline that has been off stream in 2016, early 2017. And yet there's good news that you've announced to the market in terms of being able to get oil back out without having to use barges. Can you just elaborate that, and actually, perhaps most interestingly, what shareholders can then look forward to in the second half of this year?
Well, I think one of the key attractiveness to us when we bought this asset was the near-term production opportunity. The infrastructure was already in the asset, so you're buying infrastructure, and you were buying evacuation route to the Forcados terminal that you mentioned. So it ticked all the boxes for us: near-term production, opportunity to monetize. The capital investment required to generate that monetization opportunity was already invested. So it was a very attractive opportunity. Now, take one of those factors out of the equation and you come across a problem, as we experienced in 2016. So you take away your monetization and evacuation route, and you have to overcome that difficulty. But being in the oil business my whole career, there's always something that you're going to overcome, whether you're drilling a well, whether you're manufacturing equipment. There's always the factor of the unknown, and that's why we hire the professionals that we have to overcome that. We looked at opportunities to produce alternative evacuation routes in a cost-effective way whilst Forcados was shut down. Now, initially we looked at the opportunity that the timing of the shutdown was going to be relatively short. It kept extending until we came to a position where we really needed to look at the barging option or the tankering option, which in itself was not something that we really were too keen on doing. We're an oil company that produces in a swampine environment. We're not a marine company. So as soon as you start moving the product using the tanker vessels, it's a completely different part of the business. So we weren't skilled in that area. We didn't have the expertise. What we did do is we spent a lot of time working with our peers who had decided to move earlier on the tankering option. We learned a lot of lessons learned and how they conducted their operations. And we looked at what are we not so good at. We know how to produce oil, we know how to drill wells, we know how to do all these things. Do we know how to run vessels? That's not really our skill set. So we decided to look at a contracting strategy where we would deliver the crude to the vessel, and someone else would take that vessel and deliver it to the terminal. So all the steps in between were the responsibility of the contractor. That's not something we were skilled at. We weren't used to marine operations, we weren't used to working with the port authorities. Some of our peer group decided to manage each part of that, and that created a level of complexity that whenever you have a level of complexity in our operations, it creates an opportunity for failure.
Yeah.
We tried to minimise that position by just saying, we'll deliver the crude to you. You pick it up, we do what we're good at, and let someone else, we paid a premium for this, and I accept that, let someone else do what they're good at to deliver a product.
And you mentioned a couple of times already in this interview the quality of the assets, and I actually just want to drill into the numbers because it's, for people not familiar with the story, these are quite spectacular numbers. Cost of extraction, $6 a barrel. Cost of transportation with the pipeline, $2.50 a barrel. And then a 20% royalty tax on top of that. So a very low break-even cost, particularly when Brent is touching around $60 a barrel today. Could you just unpack what that potentially means when you start to ramp up production in terms of those financials and how that makes you competitive, almost agnostic of the global spot price?
Well, you are, but you're not. I mean, we can never ignore the top line revenue position that we're all controlled by. But because the headline number of oil impacts so many things, particularly sentiment and investing in E&P companies. We are in a low-cost environment. I mean, and it goes back to asset selection. As I mentioned before, when we bought the asset, we bought it complete with infrastructure. We bought it complete with export opportunities. We bought it complete with pre-drilled wells that had been shut down. So the opportunity to bring that production back on at relatively low cost was already in front of us. Now, what we did do back in 2014, we had a change in strategy. The asset itself had quite a small, low well inventory, only 7 or 8 wells drilled. and therefore the workover potential was quite small. So we had a strategy pre-2014 to drill new wells. Quite capital intensive, but when you're looking at our business, it's much preferable to drill a new well in 2017 or 2016 than go into a 1972 well and rework it, because it's been down there a long time. However, in 2014, I was at a conference and I looked at majority of my peer group were doing exactly that. I've got my peer group going in and re-entering on old wells and increasing production. So we looked at our well inventory and decided to look at 2 particular wells that were in production to see if we could enhance that. And what we're enjoying today, the production gross of over 12,500 barrels a day, is a product of that strategy. And last year, Palma 3, we re-entered and reperforated and sealed certain sections of the well, reperforated new reservoirs, effectively creating in Palma 3 a brand new well through existing infrastructure. And the total cost of that was around $3 million for both wells. So we managed to capture that low cost production enhancement. Now, I've spent a lot of my time in the North Sea, and when people talk about workovers, they talk about things called enhanced oil recovery methods. We're not talking about that here. A workover on OP3 is a brand new well, so this well will produce for the next 15 years at a very minimal cost. You have to have the quality of the asset to give you that low cost opportunity. And there are plenty of oil and gas producing areas all around the world, all with different cost structures. You see in the Gulf of Mexico, they go for 3,000 meter wells. Very, very prolific, but also very, very expensive. We don't have those kind of flow rates, but we do have the very low cost opportunities, and it's all driven from what you have below the ground.
Right.
I know this is the $64,000 question. I don't want to ask it, but I'm going to. Like all businesses in the sector, the investment case is heavily predicated on the outlook of the global oil price. What's your view on it? Horrible question, but forgive me. It's a stupid question, but it has to be asked.
It's one of the questions. If you're running an oil company, you're always asked, and you're always expected to know the answer. And the best answer is, if I did know the answer, I wouldn't be running an oil company. But the way, for our position, we have to get our production as competitive and as efficient to the point of monetization as we can. The real issue around the oil price is about future investment. So when you look at oil price, you're saying, I've got more wells to drill. At what oil price does this investment make economic sense for me? It doesn't really, for your production costs, as we discussed earlier, being a $6 extraction cost and $2.50, that's a given. You can make that as efficient as possible, but that well's already flowing. The oil price going forward is all about, are you willing to continue with your investing activity, and at what price does that investing activity work for you? So for us, it's a mixture of the geology, and we always come back to geology because that's where the money is. It's a potential on the fiscal regime that you operate in, and the blend of your crude. So for us, right now we've been running our base case at $40 to $45. My expectation through 2017 and into beyond 2018 is to find around about $50 to $60. But at all points, our investing activity is economic. I mean, for the wells we're producing, are planning to drill now, they're running around about $13 to $15 million per well, and they're roughly working on about a 90-day payback at $45 oil.
And a lot of the recent strong performance has been based on impressive uptime numbers, and for those viewers who might not be familiar with uptime on the pipeline, that's key to getting decent export performance, decent cash flow. Can you just talk through how you've managed to achieve that and whether it can be sustained into the second half of the year?
Certainly the last 4 months uptime performance has been exceptional. I think we just reported into the market today 1% downtime, so 99% uptime. Now that's been driven primarily because Forcados has been closed for such a long time. Where all producers are pushing a lot down the line right now to try and get that cash flow catch up that they've been missing for the last 15 months. We do have to go through PPM, plan preventative maintenance online, so we do anticipate that number to come down because it certainly can't go up. So the focus on uptime, if we look back, at 2015, the last time we had a full year of production, we were around about 95% on our own asset production uptime and about 85% overall. So we control the first 36 kilometres of the evacuation, and Shell control the balance of the 36 kilometres towards Forcados. I do expect when we're doing these numbers, when we're running our revenue estimates, when we're running our economics, we run on an 80 to 85% uptime basis. And when we do see we're ahead of the curve, especially when the oil price is increasing, that early monetization, because the oil's always worth something in the ground, but it's certainly worth a lot more when we get it through the facilities. It's if we can maintain around about the 85% level, that's a very efficient operation for us.
Let me just come in here, because I think Nigeria is synonymous with oil. I mean, all the great companies had a pop there, done well. George, I think Eland is incredibly lucky to have you, because you've spent so many of your really good years in Nigeria and you know it like the back of your hand. But like any slightly doubtful retail investor, what I'd like from you is a little bit of clarification on the community, your partners, the local and national government, security. Are you happy with it? I mean, you're comfortable with it as a sort of an environment to make, the great success of the company that you're currently doing?
I think absolutely. I mean, I've spent time in Nigeria. I've lived there. In running any company, whether it's an oil company or any other type of company, you have to take account of all stakeholders in the business, whether it's the investment community, a retail investor or institutional investor, all the way through to the community that you operate within.
Yep.
And we have a responsibility there. So for me, we do run community programs. I'm very, very pleased that finally we've got the drilling rig in the community. I mean, that's been a major event for the company. I think it's been a major event for the community as well. It provides work while the rig's in location. It's the first time a rig's been there since 1981. So it's a big event, and this is a very big piece of kit. So it can be seen from a number of miles as it's coming in. So we do have a number of CSR projects. We make sure that when we're going in to operate both on workovers or drilling activity, that we award a lot of local contracts, so they're awarded within the community. On the fiscal and political environment, given the stability of the fiscal regime, the main cash flow generator for the economy is oil. You're in a very stable environment, and as I said, they're still promoting investing incentives to attract foreign investment in. And I've said many times to both to the government when I meet them in Nigeria, as Eland, our only assets are in Nigeria. So whenever I'm promoting the company, I'm very comfortable being there. I'm looking for investors to equally be comfortable, not just in the environment we operate, but they have a management team, both UK and Nigerian, that run this company, that can deliver the returns for them.
Fantastic. And one of the things that a number of viewers will be looking out for are key milestones, and one of the things to look forward to, I think, is the sidetrack in Opoama 7, which has the potential to ramp up production by about 50% for about 12,500 to 18,000 barrels a day. How's progress going on that? When can you expect to update the market?
Well, we started, we moved the rig into the location about 10 days ago, 2 weeks ago. It's been on location over the well site. We gave a little bit of an update, I think, to market about a week ago, where we successfully secured the old well and kicked off the sidetrack. So if you're looking at the levels of complexity in a drilling well, we've kicked off the two most complex parts of the operation. We do expect to complete or get to TD on the well by mid-October, and then look to announce that to market. At the same time as drilling the well, we're actually preparing the flow line activity from the flow station to the well, so that we can hook up the well very quickly to production. We expect to be able to do that within 3 days of the rig moving off-site.
Fantastic. And just across the wider portfolio, you've got Betty Oaken. What is the drilling plans over the next 12 months at that area?
Well, we've got 2 wells approved at the moment. One is this OP7 sidetrack that we're currently engaged on. And then we have Betty Oaken 1. So it's the next well in the programme for us to move the rig to and start an early production system in there. It's to the far east of the block, so it's about 30 or 40 kilometres for the rig to travel to get there. So we're looking to optimise. Is there an opportunity to do something closer to the flow station for easier monetisation? And we're in discussions with our partners to see if they agree with that solution. But Betty Oaken is, as you've seen from perhaps our Capital Markets Day's presentation, is potential to be very prolific. I mean, we're looking at the first well to deliver close to 10,000 barrels a day. And so it is a bit of a game changer.
And I wanted to come on to that because the market capitalisation, 120 million, you have the potential, if Betty Oaken, Opuama 7 go as you expect, to be one of the largest, if not the largest oil producer on AIM. What is the market currently missing that you feel it needs to understand to get that leg up in the share price?
Yeah, it's. I think we've only recently been delivering the 12,500 a day gross. Now, that work, as I mentioned earlier, came from the activities of last year, and then all of a sudden the company's into enforced hiatus because of Forcados interruption. If we had not had that issue with Forcados, you would have seen the company gradually building up its production and being much more communicated to market as we build up. So what the market's seen is effectively a company shut down, no production, a company going to a shipping operation, which is a little bit experimental to make sure we had an alternative export route. And then all of a sudden, the pipeline comes back, and the next thing the market hears, the company's doing 12,500 a day. Where did that come from?
Yeah.
So I think we've got a little bit of catch-up to do with market. I think with some of the announcements we've made recently, we're beginning to demonstrate that whilst we had a tough time in 2016 and early 2017, the Q3, you've really seen the company start to generate a lot of cash, start to be able to work its way through the difficulties we had in 2016, and that's going to continue through the second half of 2017. The position of slightly higher production, higher oil price, all that opportunity, windfall cash coming down to us is allowing us to move this forward at a much faster rate than we expected.
And I think that's then wraps up where we're looking at in terms of H2 performance being stronger than H1 and reinforcing the investment case. You mentioned the October milestone in terms of updating on Opuama 7. Just looking a little bit further ahead, where over a sort of 2-year, 3-year window do you want the drilling to have gone to, the production rates to have gone to, and the scale of the ambition?
Well, this is where I take you back to our presentation back in April when we did our first Capital Markets Day. And there were two things that were key to me there to demonstrate to market. One, my investors, the market, this audience, they see me all the time. They don't see the team that's behind me that are helping me produce the kind of results that we have. So the Capital Markets Day was an ideal opportunity for each of the disciplines that work within the company to present their position. And one of the key things that came out of there is the analysis that we've done on a G&G basis of the subsurface, where you look at the production potential of the reserves, not exploration, not appraisal work, the actual reserves, proven oil in the ground. And if you look at that particular graph, which you'll find on our website, you'll see that production potential of existing reserves can go up in excess of 80,000 barrels a day in the next 2-year period. That's capex unconstrained, but the oil is there. So there's no question the oil, again, I come back to where we started from. My job is to make sure we can get the most efficient monetisation of what we know is already there.
That was wonderful. George Maxwell, CEO of Eland Oil Gas, thank you very much.
Thank you very much.
Hugely exciting, George. We wish you well.
Thank you very much.